switch off the light here because I think it makes the screen less visible, right? Okay, friends, welcome back, everybody. I hope you can hear me well and also see me if you're joining us in Zoom. Is this correct?
Yes.
Okay, great. Now we're using a lab here because we don't really need a lecture room. I told you about this before because we'll continue working on assignment 6. One thing I'd like to warn you about if you're joining us in Zoom is that your voice is broadcasted through the entire room through loudspeakers, which is a good thing. Maybe people can hear your voice and understand how you sound like, because so far we had a very low level of sound. So I'm just telling you, if you say something in Zoom, everybody will hear, which is not a bad thing, I guess. Okay, friends, so today we'll continue working on assignment 6. I decided to start from ground zero. The reason for that was that a lot of people did not show up to our face-to-face class on Tuesday. I don't blame them for that. You know, they decided to take some time off because of that lack of spring break time. I mean, I think I need a spring break myself. You know, I feel like a bit burned out because we didn't have anything substantial. So I understand that. So I decided to kind of restart exercise assignment 6. I'm not going to tell you the background again, but I already provided you some calculations, so you don't have to enter those things again. So what I did, I created another skeleton file. It's called, let me tell you the exact name. I'll share the screen with you. Oh, not this one. Yeah, I created an updated skeleton file so we don't have to enter those tedious calculations again. So we can continue modeling our data. It's called, it's actually not here. Just one second. Okay, for some reason I didn't update it. So I'll go ahead and add this file right now because I have it on my computer. And you should open that file right now so you can continue working with us. So I'll just upload it now. So it's called a stress test skeleton 2. So right here, I will move it up under assignment 6. So don't open the skeleton, the previous skeleton file, and I'll deactivate it. Open that stress test skeleton 2. Okay, do you all see that file? Okay, please open it and save it where you can easily save it, and then maybe email to yourself if you want to continue working on it after this class. Okay, can I have a confirmation from you guys in Zoom? We're able to see to download and open the file?
Yes, sir.
Okay, good. So you should have something like this where all the calculations are entered and we're gonna work on income statement and modeling, right? So you should be able to see something like that, right? Okay, so I'll close the skeleton file and I'll go ahead and open the solutions file. And you should follow me. I think I'm not gonna wait for that much because I feel like we don't have time to go through the entire exercise if I wait for everybody to enter formulas. So try to be quick, right? I mean, I'll do what I can to help you, give you enough time to enter formulas, but try to be quick, okay? So once again, last time we talked about constants, like what those constants mean. For inputs, we talked about those modeling scenarios. We have a total of 6 scenarios in relation to market volatility. We're talking about stock market here. And also economy. We have 3 outcomes, good, okay, and poor. So in total, we have 6 outcomes or possible scenarios for a big bank, right? Here we have summary of key results. Basically, this is like a summary of results from other areas. So basically, it just draws those values from other areas of the sheet. I believe all those formulas are already entered, so you don't have to worry about that part as well, right? And last time we started doing calculations, and I think we stopped somewhere here where we calculated interest rate paid on short-term debt, right? What happens, banks, they borrow from each other, they take short-term loans. And because of that, because of the short-term loans, the interest rate tends to be higher. So the calculation depends on whether the economy is good, okay, or bad. If it's good, the interest rate is 1.5%. If it's okay, the interest rate is 1%. And if it's bad, it's 5%. And then banks also take out long-term debt, okay, for several years. Long-term debt tends to have lower interest rates. Just like mortgage rates, it's a long-term debt, have lower interest rate than, say, a consumer loan, like a car loan, right? You're probably familiar with those as well. Then we have trading account expense ratio. If volatility is high in the market and the economy is poor, the expense ratio is 1.1, which means 110%. By expense ratio, we mean overhead related to stock trading, like all those salaries that you pay to brokers, their office expenses, administrative expenses, and so forth, right? Warren Buffett, one of my ultimate authorities on investment, he says that oftentimes for investors, if you keep buying and selling, all of your money will transition into the pockets of those brokers because they will charge you a transaction fee no matter what, whether you're making money or not, right? So Warren Buffett suggests to invest your money and then just forget about it. It's invested into, I don't know, Fortune 500 companies, and then don't trade because every time you trade, you're having those transaction fees that go to brokers, right? So those are your transaction fees in relation to stock market. And then loan loss percentage. If economy is poor and volatility is high, there's a 25% default rate, which means 25% of consumers and other banks, whoever you're lending to, will not return the money, okay? And if economy is poor and market is normal, it's 12%, otherwise it's 5 or 3%. So those are the calculations and it's all entered for you, okay? So you have those calculations entered in Skeleton 2 file, correct? Okay, great. What we're gonna do next, we'll create a combined income statement and cash flow statement. If you took accounting, you know what those things mean, right? As you can tell from the name itself, an income statement allows you to calculate income for your business, how much money you're making. Again, I don't want to spend too much time here. It's well explained in accounting courses. You know that not most, all businesses, they don't do accounting on a cash basis, right? So for example, let me give you a scenario. Let's say you're selling, I don't know, trucks, you're a car dealer, okay? Somebody comes in and buys a truck on a loan. So in other words, they give you, let's say it's a $50,000 truck. They bought it today. They give you let's say $5,000 as a down payment. Everything else is a loan that they will pay to you within 5 years. Okay. So you see what happened? You made $50,000 worth of sales. So it goes to your net income statement as $50,000 in revenues, but you don't have $50,000 in cash. You only have 5,000, right? So generally accepted accounting principle that are practiced in the United States and many other countries, including Middle East, like United Arab Emirates, they force you to record revenues as they occur, not when you receive cash for them, right? So you sold the truck today, you record the transaction today, okay? So income statement is not reflective of your cash flow statement. So the ultimate goal of this statement is to create a cash flow statement to show how much cash you have on hand, okay? You know what happens sometimes to companies? They're rich on paper. In other words, if you look at their income statement, they're making money, but they don't have any cash because a lot of that income is in the form of accounts receivables, like loans, credit, right? So what happens if a company doesn't have enough cash? Is it a good situation or bad? It's a dangerous situation because that's how bankruptcies happen. One of my office mates back at the University of Houston, he was a former chief financial officer. He told me that the cash flow statement is the most important statement of all because cash is the king. You can be rich on paper, right? But if you don't have cash, you cannot meet your immediate obligations. For example, you cannot pay for your utility bills. You can be declared bankrupt as a business, right? By the way, a lot of those supposedly rich people like Elon Musk who are worth billions of dollars, you understand that they don't have billions of dollars stashed under their bed somewhere, right?
So after the declare bankruptcy, the accounts receivable still have to be paid, but that's
I'm not, actually a friend of mine is a bankruptcy lawyer. He could have explained to you like what exactly. I'm not a big expert on that. I know what happens is that once you declare bankruptcy, then the court overtakes your business and they decide who has priority of claims, right? I'm pretty sure they will still try to collect money from those accounts receivables. And then I remember, like, from those bankruptcy procedures, the last party to get payout are shareholders. So they will pay all of their creditors, utility companies, and if there's money left, they will give it back to investors, something like that, right? But again, it's like a whole field of accounting / legal practice, and to be honest, I'm not an expert. All I know is that if you don't have cash to pay your obligations, that could be the first step to bankruptcy, right? Now, a lot of businesses, they avoid bankruptcies by doing what? Like if they run out of cash, what do they do? Even before, selling assets is rarely a good idea, because if you're selling your assets, let's say your trading floor, it means that you're shooting yourself in the leg, in the sense that you're reducing your ability to make money in the future, right? What they do, they go to a bank for a loan, right? And banks like those kind of companies. I mean, they see based on your income statement that you're profitable business. It's just that right now you're not getting enough cash. So they like clients like that, right? Who banks don't like are people who are actually poor, right? So banks like to give lend money to those who are rich, and they never lend to those who are poor, who are really in financial trouble, right? So before they come bankrupt, before they file for bankruptcy, they try to borrow money from a bank. But then again, banks will not lend you in certain conditions, and we'll model those conditions here as a part of this exercise, right? So here we're trying to see how much cash we're going to have on hand, giving our income and also given the market conditions and economy conditions. So that's the most important goal, that income and cash flow statement. But in reality, this is like a simplification. Big companies, corporations, they prepare separate income and cash flow statements. Income statements outline your income for tax purposes, for reporting purposes, while cash flow statements, they actually show where the cash flow is going, right? Speaking about that, I had a very good accounting investments professor when I was an undergrad. He was a retired investment banker, and he was just doing it for fun. His final exam in his accounting course was, you need to create a cash flow statement. And cash flow statement, basically you either reconcile like where the cash went or you don't. So, it's you either get it right or it's wrong, right? So his final exam was, if you get it right, you get 100% for the exam. If you get it wrong, you get 0 for the exam, something like that, right? So, so that's how he forced people to be very particular about cash accounting, and he didn't care. Students were complaining, and he didn't care, because he didn't do it for income; he did it for fun, right? So in his class, there are 2 outcomes: you either get an F or you get a solid A. That's it. There's nothing in between. Well, anyway, so that's what we're trying to do. We're trying to see what's happening with cash. So now you should follow me and enter formulas really quick, because I don't have time to wait for everybody to enter everything. So the first line item is beginning of the year cash on hand. How much you have money in the beginning of 2016? That comes from this cell. Cash on hand at the end of the previous year. So the cell value is equals to B55, meaning it comes from this cell. That's it. Okay. And then once you do that, you just copy this formula for all 3 years. I will not say that for you. You will do it yourself. Okay. So this is your beginning cash on hand. It's equal to the end of the year cash on hand. So now let's see what's going to happen to this cash, because you replenish your cash reserves by generating profit, right? Of course, not all of that profit is in cash, right? Some of the profit is virtual. It's in terms of accounts receivables. So this is what we're going to do. First, we're going to calculate interest on consumer loans. That is done by multiplying C22 by C24. So enter this really quick. So this is amount consumer loans. This is interest rate on consumer loans. So it's basically 535,000 times 14%. Hey guys in Zoom, can you see formulas well or not?
I can see them pretty well.
You can see it well? Okay, good. So it's C22 times C24. So maybe I'll copy it here. So I'll do it like this. So this is the formula for this line. Interest on corporate loans, you multiply C23 by C25, which is amount of corporate loans by the interest that you charge. And I'll copy this formula here. So it's C23 times C25. Trading account revenues, you multiply interest rate on trading assets by trading accounts assets. So that will be your income on trading. I told you last time that there's a movement to prohibit banks from trading, and I fully support that, because banks are gambling with your money when they trade. It's okay if they gamble with the money of their shareholders, but not with regular consumers like you who bring their life savings and put it into account, right? Because if they lose, if they go bankrupt, then it's not just rich people losing their investments, it's people losing their lifetime savings. So I'm fully support that, prohibiting banks from participating in the market. So this is the formula. And here we have total revenues, which is the sum of those three cells. Or you can do like this, you can put sum, formula, open parentheses, and just hold control and drag it across those three cells. So it's sum C37, C39. And I'll copy this formula here. And then I will, if you drag it, it will be the same thing. So this is your total revenue as a bank. Okay. Now let's subtract expenses from those revenues. Interest on deposit calculated by multiplying 6 by C27. So this is your interest paid on deposits. That's what you're paying to people who bring money to your bank. And this is the total value of deposits. So once again, it's C6 times C27. Okay, interest on short-term debt, it's C58 times C28. So it's your interest rate paid on short-term debt, and the short-term debt that you're borrowing, money that you're borrowing is in this cell. Okay, so we'll talk about it later. Now, the reason this line is blank is that you're not borrowing anything, giving those conditions for these 2 years. So that's why it's empty, there's nothing there, okay? Also, you need to pay interest on your long-term debt, and you calculate it by multiplying C8, which is your interest rate on long-term debt, by, so this is your total long-term debt, that's C8 multiplied by C29, right? So it's C8 times C29. Then trading account expense, how much you're paying to your brokers, people who work for you, who invest money on behalf of the bank. So it's like their salaries, their office expense, their administrative expense, whatever they spend money on. Speaking about administrative expense, Warren Buffett, he was, and I shared that concern, during the great economic recession, he was shocked that a lot of executives of investment banks in New York, like Solomon Brothers, for example, they were rescued by the government, by Obama administration, right? Because basically they ran out of money. They were filing for bankruptcy. And if they went bankrupt, they were afraid that the entire economy would collapse, right? So they were bailed out by the government. Remember that, I don't know, maybe you were too young. Remember that movement, Occupy Wall Street? Remember that? So that was kind of outcry, public outcry, because they're saying if Main Street businesses go bankrupt, like if you own a small store in Murray and you go bankrupt because of recession, the government will not come in to rescue you. You'll go bankrupt, right? But if you're not on the Main Street, if you're on Wall Street, then the government will help you to avoid bankruptcy, right? So that's how this whole Occupy Wall Street movement started, because people were unhappy that the government is rescuing investment banks and not like small businesses. I don't have a strong, it's not like, I don't have a position here. I mean, I understand why they're rescuing the banking system. Personally, I'm leaning towards not rescuing them, right? But I understand the implications, because it will be a collapse of the entire economy, right? By the way, I was in Atlanta during that Occupy Wall Street movement, and I went to this demonstration to see what they're doing. And one thing I realized is that a lot of people who were participating in those events, they were actually homeless people. They had like tents in Atlanta, and I wanted to take a photo of them, and they almost attacked me because they were demanding money for the photo. And I said, no, I'm not going to give you money. So I started walking away. They kept chasing me and demanding money, right? So that was my experience with Occupy Wall Street movement. So nevertheless, so that's what I was saying. Warren Buffett was upset that when Obama administration rescued those investment banks, a lot of executives got huge bonuses, like 20 million, 50 million. So he was saying, what kind of bonuses are you talking about? You're failing as a business, right? But they got those bonuses. Warren Buffett made a point. I remember when he called during conference calls, he said, look, we have a very serious situation. I've been thinking about it all the way from Brooklyn on the subway. So he made a point that he's riding a subway to work, while all those executives have personal drivers and chauffeurs to drive them to Manhattan, right? eventually, Warren Buffett was ousted from management of Salomon Brothers. I guess those managers didn't like his prudence, him being so careful with money. They wanted to have those bonuses and perks and things like that. So anyways, what I'm trying to say is that trading account expense can be huge if you're employing brokers to trade for you. So trading account expense is calculated by multiplying trading account revenues by expense ratio, which is right here, 60% in our case. So it's C39 times C30. And I'll put this formula right here. Loan losses. You multiply the loan loss percentage, which is C31, by the total amount of loans that you have to consumers and corporations, right? So it's this value plus this times 3%. So this is your loan percentage. Okay. Hey, are you following me so far? Am I going too fast? Are you able to keep up? Okay. And then we have total expense calculation. Basically, we need to add all of those cells together, C42 through C46. To make it simpler, I'll just use the sum function. Sum, I'll open the parentheses, then I'll hold control and I'll just drag cursor across those 5 cells. All right, so it's the same thing. So, yeah, go ahead, please. Most likely you didn't enter the formula correctly. So double check your formula, please. So this is the formula, C31 times C22 plus C23. Go ahead, Peter.
We go to C15.
Okay, what about it? We're gonna go back to it. It's a bit complicated, to require some explanation. So we're gonna talk about this formula later.
Yeah, on C43, I'm getting the like dash. Because I don't have the.
Yeah, that's what I have on my screen as well, right here. You know, one thing, can you double check your parameters? It has to be NGGG. Is it like that in your model? Friends, unfortunately, if you make a mistake, it becomes hard to pinpoint what's exactly. So you'll have to go back and double check all the formulas. I'll give you some time to do that, and I'll work with you towards the end, right? But so far, you're getting the same results or not?
Yeah.
So did you all get the same total expense or no?
Yeah, I did.
Okay, great.
So mine for C43, it's not 900, it's just a dash, and I think like the summary of key results. Yeah, I don't have the other prime numbers besides 300,000.
So your summary of key results, do they look like this? Okay, 1 second. I'll take a break. See? So yeah, I think it's fine. Let's continue. I think it has to do with those borrowing money, right? So we'll have to work on it a bit later. So if it doesn't, so far you should get the same. Don't worry about those numbers, but you should get. But it's messing up your expenses, right?
I mean, just so far, the total expenses is 900 less. That's the 900 something.
Okay, let me double check. Looks right. Let me check it. So C58. Yeah, it's probably due to this formula, right? What do you have in C58? Sorry. Yeah, so that's why. Because we haven't entered it yet. Yeah, there is some discrepancy because the calculations are using they're using values from the short-term debt owed, right? What I suggest, because you have this value blank, right? So just put it equals to this formula is equals to B61, which means this cell, previous year short-term debt. So do that and tell me whether the results look the same after that. I was actually about to enter it, but we can do it now. So now it's all reconciled. Okay, good. C43? Is it C43 or what is that?
It was the C58.
Okay, so it looks the same now? Okay, good. So you have the same total expenses, right? Okay. All right, so can we proceed now? Everybody was able to reconcile it. I mean, we would eventually get there, but yeah, for the sake of double checking that the results are the same, I think it's worthwhile to fix it now. Okay, so now giving the total revenues and total expense, we can calculate income before tax, and that's calculated by subtracting C47 from C40. So this value minus this value, total expense. So this is income before tax, right? C40 minus C47, that's the formula. Now, after that, we'll calculate income tax expense. So this is the formula, it uses if statement. If C48 is less than 0, which means your income before tax is less than 0, your tax is 0, because in the United States, you don't pay tax on losses, right? So this is the formula. If C48 is less than 0, the tax rate, the tax that you're paying is 0. You don't pay any tax on losses, okay? But if it's not 0, so this is condition that if false, it's C4 times C48, and that's your C4 is your tax rate, which is a constant, and C48 is your net income before tax, which is this cell, okay? So I'll copy this formula for the tax calculations. And then to calculate your net income after tax, you subtract this value, income tax expense, from the income before tax. So it's C48 minus C49. Okay, did you all get there? All right, so we are done with the income part. It's a combined income statement and cash flow statement. So we calculated net income after taxes, right? In accounting, there are like many types of net income. There is earnings before income tax, and there's earnings before income tax and depreciation expenses, right? Then you have net income, which is usually people are interested in net income, right? Which means after everything, after tax, after all those depreciation expenses. Okay, so now we are done. So this is our income. Again, this is income on paper. We need to translate it to the cash position. So this is how it works. Let's start calculating our cash position. Our net cash position before borrowing and repayment of debt equals to C34 plus C50. So where's C? So this is your beginning of the year cash on hand. This is C34 plus net income after taxes. By the way, there's a simplifying assumption here. Here we assume that it's conducted, the net income value is calculated on a cash basis, because in reality, a lot of those things are not on a cash basis. But for simplification purposes, it's assumed that you got this net income in cash, okay? So once again, it's C44 plus C50. We had 300,000 in the beginning of the year, which rolled over from the previous year, and we added whatever income we made. So that's the formula. Go ahead, please.
So we deal with the year cash on hand. C34 is just about C17.
It came from here, basically. So whatever we had at the end of the previous year became our beginning of the year cash on hand, right?
So it's not the one up there at the top.
This one is basically B55, which means this value, this cell. And here we are adding this value, which is the beginning of the year cash on hand, plus whatever income we made, because when you make income, you generate additional cash for your business, right? So that's the logic here. Okay, and then we need to decide whether we're going to increase borrowing or not. This is the formula that we're using. If C52 is greater than C5, so C52 is your net cash position. If your net cash position, which means how much money you have in the beginning of the year, is greater than C5, which is the minimum amount of cash you need to start the year with, it comes from here. So if C58 is greater than C5, then the value is 0, which means you don't increase borrowing. You have enough cash to start conduct your operations as a bank. If not, condition is false, then borrow the difference between C5 and C52. In other words, if C52, your net cash positions falls short of C5, which is 50,000, borrow so that your cash position is at least 50,000. If you don't have at least 50,000 in cash in your account, you may have a run on the bank situation where your clients are coming and asking to close their accounts and you don't have enough cash to return them their money. That's why we need to have at least 50,000. By the way, it's a big bank, it's in millions, so it's not 50,000. I think it's what, 50 billion cash. So that's what I remember. Those numbers are millions, right? I mean, sounds staggering, but for a big investment bank, it's not a big amount, right? We can quickly look up how many assets under management for Bank of America. You know what's the total assets of Bank of America? It's 2.26 trillion, right? So having 50 billion in cash reserves is not that big of a requirement for Bank of America. It seems to be like a healthy requirement. So once again, if your net cash position C52 is greater than 50,000, it's actually 50 billion, but we're using thousands for simplicity. Then don't borrow anything. Otherwise, borrow the difference. Since it's greater, this value is greater than 50,000, we have enough cash and we're not borrowing anything, okay? So let me copy formula and I'll put it right here. Now we also need to think about repaying of debt. And here's the formula. If C58 equals to 0, which means this cell equals to 0, then repayment of debt is 0, which means we're not going to repay anything. We don't have money to repay anything, right? Then second nested if statement, condition if false. If C52 is greater than 58, which means the amount that you have on hand is less than 50,000, the repayment is 0 again. You don't repay anything because you need to have that cash to start your year with, okay? Then condition if false, we have third if statement. However, if C52 minus C5, which means this cell minus 50,000 is greater than C58, and C58 is beginning of the year short-term debt owed. If it's greater, right, then go ahead and repay the entire debt. So the value will be C58, which means equals to this debt. In other words, if you have enough cash to repay your short-term debt, you will go ahead and repay it immediately because the interest rate on short-term debt tends to be very high. That's why banks or any prudent businesses, they like to pay short-term short-term loans as soon as possible. At the consumer level, it can be translated to credit cards, right? I mean, I hope you're blessed and you don't have any credit card debt, okay? Because if you know that through experience, credit cards, they charge ridiculous interest rates, right? So if you can repay your credit card loan as soon as possible, because you're going to lose a lot of money on the interest rate. So I'll give you some time to enter this formula for the repayment of debt. make sure you have correct number of parentheses, because sometimes you put an extra one or you forget one and it gives you an error.
For a second, it only showed me the dash, and it was because I had the symbol flipped for less than greater than.
Okay. Yeah, it's a tedious data entry exercise. Well, still, it's faster if you try to do it on your own, right? So did you all enter this formula? Okay, I'll go ahead and I'll copy it here on the side in case you want to double check something. What about you guys in Zoom? Did you enter this formula?
Yep, I did.
Okay, thanks for the confirmation. So basically what happens, you have a lot of cash on hand this year and you'll go ahead and repay your all short-term debt obligations, which is 60,000, right? And that will bring you end of the year cash on hand to less to your beginning to your net cash position minus whatever you're repaying, right? So this is how the end of the year cash on hand position is calculated. You take your net cash position from operations, you add what you borrow because you borrow in cash, and you subtract what you repay. Since you don't borrow anything, you don't need money to borrow, you're doing well financially, it will be blank, it will be zero, right? But that's the formula, C52 plus whatever you're borrowing minus whatever you're repaying on your loan. I'll put this formula right here. Okay, so we're done with cash calculations, right? Now let's do calculations for short-term debt owed. We already did this cell. It basically pulls value from B61 from this cell. So at the end of the previous year, you had $60,000 worth of short-term debt, and you're just copying it here. You're saying, okay, if I had it at the end of the year, then I'm starting 2016 with the same kind of debt. And then you'll add increase in borrowing, which is C53 cell. So it equals C53, and here it's just B61 equals to B61. Then less repayment of debt. This cell equals to C54. And then end of the year short-term debt owed is calculated by taking beginning of the year short-term debt owed, adding increases in borrowing, which is C59, and subtracting repayment of debt, which is C60. So that's the formula here. So at the end of the year, this is how much you owe. By the way, it's nothing in our case. You don't owe any short-term debt because you repaid everything, right? So those are the calculations. And these are final stress test computations. So the first thing that we will do for all 3 years, we'll calculate return on equity. And return on equity is calculated as follows. You take C50, which is your net income after tax, and you divide it by base equity, which is C9. It's a constant, okay? By the way, return on equity shows you how profitable of a business you are, right? So here it shows that on every dollar of equity, you're making 49 cents in profit. That's what we mean by return on equity. Last time we said that equity is how much shareholders invested, how much they own in that particular business, okay? So that, you know, again, if you took accounting, you understand in general, like for example, if Walmart says our profit is, I don't know, $50 million, right? And then let's say a small frame company here on 641 says, our profit for this year is $100,000. You see, you cannot really compare those businesses because for Walmart, making $50 million can be nothing. It's a very low profitability because their equity, the amount of money invested by shareholders is huge, right? But for a small business, making 100,000 could be a sign of a big success, right? So that's why you need to have a ratio, okay? So this bank seems to be very profitable. They're making 50 cents on every dollar that they invested. So basically 50% return. How about that? It's a very high return percentage, right? And you're going to copy it for all 3 years. Now here, I believe I entered the formula for you already in the skeleton, right? So let me just explain the logic of this formula, okay? So this is the ultimate stress test. Look, we're testing for a situation where you as a bank, you need to borrow money, but nobody will give you money, okay? I told you that banks like to lend money to profitable companies. In our companies that are in good financial health, it's just that right now they need some cash to cover their obligations, right? So basically this is what happens. If your base equity drops too low, and you lose money, nobody will be willing to lend you, okay? So this is the logic of this formula. If your return on equity, which is C64, which is this cell, drops below 1 cent, which is low, right? And C59, which is your increase in borrowing, is greater than 0. So in other words, your base equity is low, your return on equity is low, but you're borrowing money, then your bank fails. It means that you need to increase your borrowing, but your return on equity is very low, right? So in other words, you need money, but you're not in good financial health. Nobody will give you anything, and that's why it's fail. You go bankrupt as a business, okay? If this is not true, then we check for second if statement. If base equity is below 1 cent, but you're not borrowing, it means hold. Hold means you're not in a good financial state, but you're not borrowing money, so you will survive. You will not go bankrupt. Hold means it's not a good situation, but okay, we're holding, we're holding business under control, something like that. And all other scenarios is pass. When you have high return on equity and you want to borrow, you will pass that economic situation. Okay, so that's the formula. And then again, you'll copy it. So as you can see, when the market volatility is normal, which means the market is stable and the economy is good, what happens to the bank? It passes the stress test, nothing will happen. Now let's see if market volatility is high, but the economy is good. So I'll change it to H. It will pass, okay? Now what happens if market volatility is high, but the economy is okay? It will still pass, okay? Now the problem becomes when market volatility is high, but the economy is poor. So let's say it's poor for the first 2 years. It means you will fail in the second year, right? If it's poor for all 3 years, then you'll definitely fail. If not in year 2, then in year 3, you'll go bankrupt as a bank, right? If it's okay in the first year, but then poor, you will fail in the 3rd year as a bank, right? So look, we could have done this manually. We could have looked at all those scenarios manually. By the way, this tab, I will do it right now so that I don't forget. It's called stress test BSS. I'll rename this tab. So you see, we could manually analyze all 6 possible scenarios because, as somebody told us last time, we have 6 possible outcomes on this model. We have 2 outcomes for market and 3 outcomes for economy. 2 times 3, we have 6 combinations of those factors, okay? As it turns out, there is a feature in Excel that allows you to automate your scenario summary, okay? And you will find this feature here. Go to data, please, and then select what if analysis. And then select scenario manager right here. By the way, did I add those scenarios already? Do you see those scenarios entered, those 4 scenarios entered in your skeleton file or not? You do? Okay. So so that saves you time. I kind of did it on purpose because people also have problems entering all those scenarios. I'll just maybe add like 2 additional scenarios. So look, what happens, you can add scenarios 1 at a time and then generate a summary of the outcomes. So look, this is the scenario when market volatility is high and the economy is poor for 3 years. So when you click on edit, you will see that the scenario name is poor high. Changing cells are C12, C13, and E13. So basically, we're talking about, let me scroll up. I'll just show you. Yeah, so it's here. So let me go again to data, what if analysis, scenario manager. So the scenario name is poor high. Changing cells are C12, which is this cell, and then C13 through E13, which means these 4 cells, okay? When you click OK, it will ask you, okay, so what will be the values in those cells? It will be HPPP, right? So that's the scenario. When you press OK, you added this scenario, okay? And those scenarios are already added for you. So we have poor, high, poor, normal, okay, high, okay, normal, and then we're missing 2 scenarios. We can just add them right now. I'm just trying to enumerate. Yeah, we're missing like those in-between scenarios, right? So let's just add one. Let me check 1 second. Let me add this scenario. So it's like okay and then poor. So we'll add scenario will be okay. It's called okay, then poor. So those are the values already entered. So it will be H, O, P, P, right? So this okay and then poor. So you press OK, and then we added 5th scenario, right? This is just to demonstrate you how to add the scenarios, right? And they already added for you. And then once you add those, by the way, you only need 4. So I already entered those 4 for you. So I'll go ahead and I'll delete that 5th scenario that I added just for demonstration purposes. You go to summary, and it asks you, do you want to create a pivot table or a summary? You'll create a simple summary, right? And the result cells, they already selected for you. Short-term debt, how much short-term debt you own, and the overall conclusion, pass or fail. So it's basically a copy of these 3 cells. So you can do it by selecting them like this. Okay. And when you press OK, you'll get the scenario summary. So here, here it depicts current values. You can delete this column because you don't need this scenario. You only need 4 scenarios that we entered. So I'll just delete that. Okay. So look, guys, we are done. So let's name this tab scenario summary. It's already named like that. And I already like partially formatted. So what you need to do to complete this assignment, you need to format. First of all, for the changing cells, don't keep just the cell value, enter the name of that value, right? So here, economy 2016, economy 2017. So add labels for these cells, what those cells mean, right? And do it for all rows. Go ahead, please.
Can you go back to this, how you highlight this?
No, you need to look for the scenario summary. Go to what if analysis. Let me show you again on this picture. Yeah, I'll show you again how I generated this summary. So you need to go to data, what if analysis scenario manager. And you should have all the 4 scenarios entered for you already, right? Do you see them? Tucker, do you see them? Those 4 scenarios? Yeah, you go to data, what if analysis scenario manager, and you should have 4 scenarios entered like this, right? And then create summary. So click on the summary button right here. And it says, okay, what are the result cells of those scenarios? So these cells need to be selected. Are they selected? I was just showing you if they're not selected, you can select that selection. Sorry for tautology. You can select that selection button and just grab those 6 cells like this. And when you press OK, it will generate the summary. So I told you like delete this current values because that's additional scenario that you don't need. And then format it here, just put like the names of those cells. So here it's economy, here it's short-term debt. I'm sorry? Yeah, I just selected the table like that, the cell like that. Let me show you again. I just selected the entire column and I selected delete like this. Did you see it on the screen? So I right click on this column, which has current values. I right click and select delete, okay? So as for the assignment, this is what's remaining. Put the labels so that we know what those cells mean. So pull it from the main model, right? And then write your own interpretation in this. So in other words, what do you see based on the model, right? So you can say, well, based on the model, we see that overall the bank will be doing well during certain conditions, but there are some dangerous conditions, and those conditions include this. If this happens, then the bank is likely to fail. So that's the kind of analysis that you can provide based on the model. Okay, so make sure you add your analysis somewhere here below so I can read it. Okay, so what do you see based on those outcomes? What I see is that the bank seems to be quite strong. Look, during normal conditions and somewhat unfavorable conditions, it will hold or pass. However, during extreme conditions, it will fail, right? So if we are regulators, we need to be mindful of those extreme conditions. We need to step in and offer this bank some kind of assistance unless we want it to go bankrupt and pay for its risky decisions, right? However, again, the counter argument here is that if you allow a bank like that to go bankrupt, then the entire economy may collapse. So that's why government usually would intervene in the situation. But the government will not intervene if your small business on Main Street fails, right? So what do you think about government rescuing all those banks? Like what happened in 2008, 2009? Is it a good thing, a bad thing?
I mean, there's pros and cons, I guess, because they probably should know, but at the same time, the economy quickly collapsed. So it made them for the best, but it was more like almost tearing off the band-aid. Like it's good to go ahead and get it off.
Yeah, I like that band-aid analogy. You know, I'm kind of like leaning towards letting them go bankrupt, but I'm not willing to make that kind of tough choice because everybody will suffer because of that, right? But at the same time, I agree it's a band-aid and this thing will recur again because banks are allowed to gamble with other people's money by investing, by borrowing, by lending, and that's something they shouldn't be doing, right? I mean, and to me, a bank should be more for like a utility service, like a stable utility company. You bring your money, they hold it for you, they give it back. They make safe investments, you know, something like that without gambling in the stock market. And that's about it, right? They should not be actively involved in the trading business. So that's the last thing that is remaining. So I'm done with the formal portion. So what I will do, I will take attendance. And after that, if you're lost, you can ask for help or you can just keep working on that last part and maybe you can get it done today, okay? So let me take attendance before we leave, if you don't mind.
We still need to do the other columns, right? With the 2017, 18, just do it kind of like how.
Which columns are you talking about?
2017.
Oh yeah, you need to. I told you that every formula that I enter, you need to drag it for 3 years. So let me show you what exactly I'm talking about here. So whenever you enter something here, like I told you what the formula is, you need to click on this small green square and drag it across all years. Otherwise, your model will not be completed. Okay, so I'll take attendance and then you can stay to work on the assignment to finish up the assignment or ask me any questions that you may have. So we did well today. I was afraid that we're going to run out of time, but it looks like everybody kept up quite well. I'm hoping so, though. Clifton?
Here.
Thank you. Braden?
I am here.
Nathan?
Here.
Devontae? Not here. Aaron? David?
Here.
Thank you. Jessica?
I'm here.
Hope?
Here.
Sean?
Here.
Harrison?
Here.
Tristan?
Here.
Violet?
I'm here.
Thank you. Mason?
Here.
Ahmed?
Here.
Thank you. Now the Zoom section. Wesley?
Here.
Aaron? Haney? Aaron not here. Tucker?
Here.
Chinese?
Here.
Jacob?
Here.
Caitlin? Jason Reynolds?
Here.
Thank you. Brendan,
Here.
Casey.
Here.
Okay, thank you very much. Friends, we're gonna do the same exercise. We're gonna work together on assignment 7, okay? So please make sure you're on time, ready to work, because it will be like a fairly sophisticated model that will involve some optimization. We have some, depending on the configuration of the computer, we may run it for like 3 minutes to find an optimal solution, right? So when you come to the lab on Thursday or join us in Zoom, make sure you have 2 things. One second, I'll show you. Make sure you read about the case. It's called St. Bernard Bus Company, something like that. So it's based on case 8 from your textbook. It's called St. Bernard Bus Line. So make sure you read the case prior to our next class, because I'm not going to spend time giving you an overview. We need to work on the model itself. And also make sure you have the skeleton file open and ready to go. So this is the skeleton file. So make sure you open the skeleton file before the start of the class, because we'll start entering our data in that skeleton file. I think this exercise is quite interesting. We'll see another advanced function of Excel, which is linear optimization, finding optimal solution based on the variables and constraints that you give. By the way, one of my colleagues at Abu Dhabi University, well, he was actually a student. He was working for Abu Dhabi Ports. And then what happened, he learned about optimization in one of my class, and he was raving about it. He did so much for his work trying to optimize like loading, unloading of containers. And I had another student here. He was actually working for Pella manufacturing plant. And he told me that he was using that optimization to optimize his scheduling, allocation of materials and employees to those machines, because he was like a shift supervisor, stuff like that, right? So it's really one of those amazing features of Microsoft Excel. Think artificial intelligence, right? So that was that thing existed way before people started talking about artificial intelligence, things like that. So it's like an artificial brute force artificial intelligence approach, where the computer tries different combinations until it finds an optimal solutions, right? So it's like trial and error approach to optimize something that is not really governed by strict mathematical equations. Okay, so I think it will be an interesting class. So make sure you show up. Again, if you show up and you're ready to work, the benefit is that you may be done with assignment 7 in class, or you'll do most of it. It will be due on Monday, right? Like a few days after our Thursday lab. But again, if you show up in the lab and you do everything, you'll do like at least 80 or 90% of that assignment, okay? I'll probably leave you with one task to optimize for a more advanced model, but you'll be able to accomplish at least 80% of what's needed in class, okay? All right, friends, so we are done with the formal part. Again, you're free to stay. We still have 15 minutes left, or you can leave if you're done with this assignment. So you can stay to complete your assignment or ask me questions.
I actually have a quick question, if you don't mind.
Okay, go ahead, Brayden.
So I was putting in the info or the formulas, and I did not get the same thing. I might have been lost somewhere, but I can share my screen with you if you want.
Okay, so do you have the same variables here? I mean, HOO, like let's put, if you put, let's say, normal and good, will you get the same results or not?
So I get different results, but I'm just not getting the results that you're getting.
Okay, okay. Well, show me your screen. I'll try to quickly find where the error is, but you can also double check those formulas. Okay, share the screen, please. I'll give you co-host privileges. 1 second.
I thought I did put them in right, and I did check, but I'm still not getting the.
Okay,
I went ahead and made all the formulas.
I'm giving you
available.
co-host privileges so you can share your screen. I'll try to see what you have.
There you go. I went ahead and turned all the formulas on so you can see exactly what they are.
Yeah, turn the formulas on, because I'll see which values have discrepancies and I'll try to go from there.
I'm trying to turn them off, but there we go.
Okay, so can you move left so I can see? Yeah, so I can see the labels as well. Okay, yeah, hold it there. Yeah, 1 second. I'll try to double check what he has. All right, you too. So the calculations seem to be right. I gave you those values. Can you scroll down, please? Well, look, you don't have entered beginning of the year cash on hand, right? So that needs to be copied for all the years. Scroll up, please. Okay, the first error that I see is total expense. Can you click on the total expense cell? It's below, yeah. Can you double click on it, please? So it's C42. Okay, do it again, please. Close it. That's a mystery. Oh, okay, trading account expense is wrong. Can you click on the trading account expense? So it's C39 times C30.
That's what I have.
Can you scroll up to C30, please? See, okay. Okay, trading. Okay, then close it. Just, yeah. Trading account revenue seems to be wrong. Can you click on trading account revenues? Yeah, trading account revenues, the formula is not sum, it's C7 times C26. Oh, you're clicking on the sum, right? Where are you clicking on? So I don't see it.
Oh, I'm so sorry.
Yeah, click on trading account revenues. Yeah. So trading
Okay.
account revenues should be C7 times C26. Oh,
You
look,
said 20.
look, you have the cells messed up. Look, this is what's happening. You entered 74,900 for the revenue. That's not correct. The correct place is interest and consumer loans. So basically you need to push everything down. Let me show you like on my screen.
Okay.
So that's where the error is, I think. So let me share my screen again. I'll discontinue.
Okay.
So this is where you have this value here for some reason. You see?
I don't believe the right thing is shared with me.
One sec. Can you see my Excel sheet?
Yes, I can.
You see, you have this value entered here next to revenues.
Oh, I have everything down or up one too high.
So double check this part and it should work.
Okay. Thank you so much.
Yeah, it's not gonna work because the model is not going to be. Go to your stress test model again. See, it didn't copy the photo twice. So yeah, so basically you go in here and then drag it across the year. Okay. You just click here on this value where you enter the formula and then no, not with this. Click on this square, this green square in the corner. Click here again. Yeah, and then copy it like this. Yeah, and drop it. And then the same thing here. I think you missed some of the values. And then copy all the rest formulas.
So we don't have to go like.
No, that's the beauty of Excel. You just copy cells from one year to the next. It will automatically shift all the parameters.
So like.
Yeah, drag it for the next year as well.
Just do it one by one.
Just at once. Copy it also. Well, it's already correct, right? Yeah, you can try that. Here it's empty because it will grab the value from below. Here it's empty.
All right. Okay, so I got two more slides. Like down here.
Well, I mean, tabs. I was just generating to show you how it works. You need to have only one scenario. So it's empty because it didn't enter all the values. I just did it 3 times. All right, thank you. See you later.
Besides the creating an actual summary, the only other thing with here is like short few sentences, right?
Yeah, analysis. What kind of recommendation can you make to the bank based on those scenario outcomes? I mean, my recommendation would be to watch out for extreme market conditions. I would say that overall the bank seems to be in good health. It seems to pass all those test conditions, but in extreme conditions, the bank is likely to fail. So the managers of the bank need to watch out for those extreme conditions of high market volatility and poor economy.
That's what I kind of said, like, I don't like to take risk and like looking at it like it would fail miserably if it wasn't like a before.
But of course, like if you're talking about a bank like that, you want to be bulletproof even during those extreme conditions. So that's a concern, right? Maybe if you're really insightful, you can give them recommendations beyond that, how to avoid those extreme conditions. For example, if you see that most of the losses are coming from trading, then you can say that banks should avoid trading in extreme market conditions because that can lead to fail situation, you know, and since it's a large bank, it will collapse the entire economy, something like that.
I found class by luck today because I didn't see your email until.
Yeah. Well, I'm sorry. I don't know how to do it.
It's not your fault. See, I would have seen it automatically, but my phone over the weekend just decided to kill itself. So it screened everything else on the phone works fine.
Well, that's fine. You found us.
But I was walking down because I was like, well, he's not in the lab, he's not in the classroom. I guess we're not having class today. I'm just gonna get some food and leave. And I was like,
Well,
I hear a familiar voice.
it's God wanted you to be here today.
Yeah.
He guided you.
Then Thursday we will be in the normal lab.
Yeah. I just borrowed this lab so that we have extra time.
Gotcha.
All right, Mason. See you on Thursday.
Bye, Dr. Krotov.
Okay, bye. See you on Thursday.
You too.